Financial ratios are essential tools for analyzing a company's performance and financial health. Investors, analysts, and business owners use these ratios to assess profitability, liquidity, efficiency, and overall stability. By understanding key financial ratios, one can make informed investment and business decisions. Below are the top 10 financial ratios that help determine a company's performance. 1. Current ratio. The current ratio measures a company's ability to cover short-term liabilities with short-term assets. It is calculated as current ratio equals current assets, current liabilities. A ratio above 1 indicates a company has enough assets to cover its liabilities, while a ratio below the 1st of May signal liquidity issues. 2. Quick ratio, acid test ratio. The quick ratio is a stricter test of liquidity than the current ratio. It excludes inventory and focuses on highly liquid assets. The formula is quick ratio equals current assets, inventory, current liabilities. A higher quick ratio suggests a company can meet short-term obligations without relying on inventory sales. 3. Debt-to-equity ratio, D/E ratio. This ratio evaluates a company's financial leverage by comparing its total debt to shareholders' equity. It is calculated as debt-to-equity ratio equals total debt, total equity. A high D/E ratio indicates that a company relies more on debt financing, which may increase financial risk. 4. Return on equity, ROE. ROE measures a company's ability to generate profits from shareholders' investments. The formula is return on equity equals net income, shareholders' equity. A higher ROE indicates efficient use of equity capital to generate profits. 5. Return on assets, ROA. ROA evaluates how efficiently a company uses its assets to generate profits. It is calculated as return on assets equals net income, total asset. A higher ROA means better asset utilization and profitability. 6. Earnings per share, EPS. EPS is a key metric for investors, as it shows a company's profitability per share. It is calculated as EPS equals net income, preferred dividends, average outstanding shares. Higher EPS indicates better profitability and potential for stock price growth. 7. Price to earnings ratio, P/E ratio. The P/E ratio compares a company's stock price to its earnings per share. It is calculated as cheeky smiley face E ratio equals market price per share, earnings per share. A high P/E ratio suggests that investors expect future growth, while a low ratio may indicate undervaluation. 8. Gross profit margin. Gross profit margin measures how efficiently a company produces goods or services. The formula is gross profit margin equals revenue, cost of goods sold, revenue times 100. A higher margin suggests strong profitability and cost control. 9. Operating margin. Operating margin shows the percentage of revenue left after covering operating expenses. It is calculated as operating margin equals operating income, revenue times 100. A higher operating margin indicates strong operational efficiency. 10. Asset turnover ratio. This ratio measures how efficiently a company uses its assets to generate revenue. The formula is asset turnover ratio equals net sales, average total assets. A higher ratio indicates better efficiency in using assets for sales generation. Understanding these financial ratios helps investors and business owners assess a company's financial health and performance. By analyzing liquidity, profitability, and efficiency, one can make informed decisions for investments or business growth. Regularly reviewing these ratios ensures better financial planning and long-term success.